This is the Asia Trade. I'm Paul Allen in Sydney, where markets have just opened.
I'm Haidi Stroud-Watts. The top stories this hour. Asian stocks are set for a cautious open as traders look to Friday's US jobs report. The latest Fed minutes showing officials are eager to slow the pace of rate cuts. Treasuries rebounding on a solid 30-year auction.
A Bloomberg scoop. The Biden administration set to further limit exports of Nvidia and AMD AI chips in a final salvo against China's tech ambitions.
Also ahead, we're live at the Malaysia Economic Forum in Kuala Lumpur to hear exclusively from the country's finance minister and the Maybank Group CEO.
And I'm Min Lo at the Morgan Stanley Asia Wealth Summit in Hong Kong, where we'll speak exclusively with the bank's wealth management head, APAC wealth management head, Vincent Chui, about their key investment themes in 2025.
Let's take a look at some of the key themes when it comes to today's investing agenda and how traders will be watching. And we've, of course, got sort of the end of the week with the US data that, of course, we're going to see sort of potentially, real meaningful implications for what we're seeing across bond and FX markets. But for China, we're also getting CPI numbers as well. And, of course, this sort of, big promise of heavier stimulus as we headed into the end of the year hasn't quite sort of materialized yet in terms of meaningful economic support. We've had those PMI numbers, for example, that were quite a drag as well. And this set of CPI numbers really comes as we, get into, I guess, sort of the danger mentality, right? Is this the start of a deflationary spiral? Is China already in that confidence spiral? We know how hard it is to sort of pull it out, not to sort of overdo comparisons with Japan, for example, but that confidence, the deflationary mindset is really front and center here. Bloomberg Economics basically saying that we're seeing, no inflation. So quite a bit of this lingering deflation risk is what's at stake here for China.
Yeah, deflation definitely a live issue there, and inflation still a very much a live issue in the United States. We were looking forward to getting those Fed December minutes in terms of just how close that decision was to continue cutting rates, and it was close. The minutes show an eagerness to slow the pace of easing due to those higher inflation readings, strong spending, reduced risks to the labour market. The economy in the US is looking strong. So we had a number of Fed members in those minutes, including placeholder assumptions in their projections about upside risks to inflation going forward. All of that said, though, the Fed Governor Chris Waller sees inflation continuing to cool, and he supports more easing. Let's hear what he had to say.
My bottom line message is that I believe more cuts will be appropriate. If the outlook evolves as I have described here, I will support continuing to cut our policy rate in 2025. The pace of those cuts will depend on how much progress we make on inflation, while keeping the labor market from weakening.
Well, it was a pretty subdued day for US markets. We did have the S&P up modestly. We see futures a little bit softer going forward. The Nasdaq was pretty much flat, and Nasdaq futures also looking a little bit softer as well. You mentioned it was a strong US 30-year auction. We did have the 20-year yield briefly touching 5% as well. But US equities cash markets going to be closed tomorrow. It's a national day of mourning for Jimmy Carter. Take a look at the oil price. It slipped after failing to breach the 200-day moving average, but short-term fundamentals do suggest a tighter market going forward. US crude inventories fell by almost 1 million barrels, and of course there's a cold snap in the US which suggests stronger demand, but longer term the market's still tilted towards oversupply, Heidi.
Yeah, cold snap, but of course we're also watching those terrible wildfire developments in LA as well. But Paul, this is a setup as we get into the start of trading this Thursday session. Caution is the name of the game, isn't it? We have Aussie stocks coming online just in the first few minutes of that staggered open, about 0.25% softer there. Really looking pretty muted across the region. Wall Street traders really refraining from any big bets, and that looks to be the trend as we head into Asian trading proper.
Well, the Biden administration's planning further restrictions on the export of AI chips from the likes of Nvidia and AMD, and this is in a final push to keep advanced technologies out of the hands of Russia and China. For more on this, let's bring in Bloomberg's Mackenzie Hawkins. So, Mackenzie, in terms of the new regulations, there's going to be 3 tiers of restrictions. What are the details?
So basically, for the past several years, the United States has been restricting the shipment of advanced semiconductors to a host of countries with a pretty heavy focus on China. And over the past year, you've seen the scope of those controls begin to expand. The latest rules, which are set to be published as soon as Friday, cover chip shipments to the entire world. There's a small group, a tier 1 group of the US and 18 allies that would be relatively free to ship AI chips to data centers in those countries, which include places like South Korea, Taiwan, and Germany. Then there's a very restricted list of about 24 countries that includes places with which the U.S. has an arms embargo. Think China, Russia, Iran. But everyone else, so most of the Middle East and Southeast Asia, large parts of Latin America and Africa, fall into Tier 2, where there's a maximum limit on the total amount of compute that can be shipped to any one country. But companies headquartered in those places can apply to bypass that limit if they meet U.S. security and human rights standards. So it's a super complicated rule. Basically, the U.S. is trying to control and have an American footprint on the diffusion of American AI chips around the world as countries race to build their own AI capabilities.
Mackenzie, given that sort of being tough, the hawkishness towards China and some of these other foreign players is sort of quite widely supported, depending on, regardless of which side of the aisle you're talking about, are we expecting that these measures will stick around even in the Trump administration?
It's certainly hard to say. Trump is an unpredictable character, but there is bipartisan support for this type of movement in Washington. We saw the bipartisan House Select Committee on China, the top Democrat and Republican, writing to the Biden administration in support of these types of rules. Pottinger, who was Trump's deputy national security advisor, wrote an op-ed in the Wall Street Journal earlier this week in support of this type of framework as well. But time will tell when Trump takes office on January 20th.
Bloomberg's Mackenzie Hawkins there. And as we mentioned just a few minutes ago, we do get China's December inflation numbers in a couple of hours' time. Economists expecting CPI to have weakened closer to zero. Meanwhile, the latest Fed minutes showing that officials are deciding to slow the pace of easing on these elevated inflation risks. Bloomberg's global economics correspondent Andy Curran joins us now for more. And so, very much a tale of two economies and two very different situations. But let me start off with China, because we're having a big conversation about the sort of whether China is looking down the future of being potentially repeating what we've seen in Japan. That deflationary spiral, the sort of confidence trap, is there evidence that the Chinese economy and households are already stuck in it?
Well, today's numbers are expected to confirm, Heidi, like you say, that the China inflation story really isn't going anywhere. Consumer prices heading back towards zero territory. Producer prices already negative. And that suggests a couple of things. Most importantly, that all of the policy traction that the authorities have tried to push through, all the policy measures the authorities have tried to push through the economy over the past few months haven't yet gained traction. And that's going to be a real worry for the rest of the world as well, because there is some concern that China might become a significant source of deflation. Now, that's politically sensitive in terms of, we know, the overcapacity debate and China exporting goods at cut prices around the world. So there's a global spillover angle there as well. But there's also the economic growth angle in terms of if China continues to stutter, that's not great for the rest of the world. Now, within the numbers, there's obviously some seasonal impacts. There's the impact from vegetable prices, as always, around this time of year. But I think for the rest of the world, looking at the China inflation data today, it does not suggest the economy is getting traction. And it does suggest there's a lot more pressure on the authorities to put more money and support into the economy in the year ahead.
Yeah, so as Heidi suggests, is this idea of Japanification still avoidable, or is China already there in some respects?
Well, obviously, it's a popular talking point. The evidence does stack up, at least on a kind of a headline basis. You look at demographics, you look at the real estate story, you look at where the debt trajectory has been going. But the authorities do have significant levers still to pull, Paul. I mean, they have said this year, for example, are going to put a lot more money into the economy, and they're probably expected to still set a fairly ambitious growth target, suggesting that even leaving aside the scepticism around those numbers, that it suggests they're going to have to put some real support on the ground. The NPC in March, I think, will be critical as a signal both for China's own people and for the rest of the world, just how serious the authorities are. But let's not forget that You know, they probably are holding their powder dry because, like everybody else, we're waiting to see what specifics come out of the new Trump administration in terms of China policy, tariffs and trade restrictions and everything else. So they're probably holding to see what comes out of that. But by all accounts, there's a lot of attention on the MPC, and the authorities are expected to show that they're going to spend a lot more money this year to prop things up.
And of course, we're very closely watching the Fed. What did you make of, I guess, the sort of nuance in terms of where they're likely to go and kind of resetting the expectations for the pace of easing this year?
I think Haidi, the minute today, confirmed that the Fed now want to, probably go and hold for a while. They've cut by a full percentage point since September. These minutes were for the December meeting when they cut by 25 basis points. By all accounts, the officials were getting a little bit uncomfortable about that because things are holding up pretty well here. There's still pockets of services inflation that hasn't gone away. The jobs market is fairly robust. We have figures coming out on Friday morning expected to show unemployment holding steady in the low fours, 160-odd thousand jobs added in a month. That's pretty good. And we had some numbers on the services side of things this week showing pretty decent expansion there. Some people saying the manufacturing side of things is probably bottoming out as well. So all told, the economy is holding up. There's certainly a school of thought that they don't want to be cutting much further from here until they start to see inflation get back on that trajectory back towards 2%. But that's the here and now. We know we're going to significant policy change in just 2 weeks from now. It will be a new administration. They will be pulling different levers. Near term, it's not expected to completely upset the positive growth story for the US, but second half of this year, maybe into next year, people are warning there may be more inflation pressures building, and the Fed are signalling that they're ready to go and hold down. Just wait and see how things play out in the coming months.
All right, Bloomberg global economy correspondent Enda Curran there. Well, advisors to President-elect Donald Trump are said to be considering Michelle Bowman as the Fed's next vice chair for supervision. Michael Barr has said he will step down from the vice chair role while retaining his seat on the Fed's board of governors. Trump's advisors have also begun drawing up a short list of potential replacements for Chair Jerome Powell. His term ends in May 2026. Heidi.
Still ahead, Paul, destructive winds are fanning wildfires in Los Angeles that have forced thousands of people to leave their homes. We'll bring you a live update from the scene next. This is Bloomberg. Take a look at what we're watching as we head into a pretty muted start to trading here in Asia. In fact, we're seeing Australian stocks extending losses of about 0.6% lower there in the first 15 minutes or so of trade. Chicago Nikkei futures also looking pretty lackluster there as well. S&P futures also looking like we'll see that tone of caution as we head into the end of the week with potential for a jolt from those jobs numbers. Well, Morgan Stanley is hosting its annual Asia Investment Conference in Hong Kong. It brings together investors, top leaders in business and finance. Our China correspondent Min Min Lo is there and standing by with our next guest. Min Min.
Hey Heidi, joining me here is the head of Asia Pacific Wealth Management at Morgan Stanley, Vincent Chui. Vincent, so great to be here today at the 10th anniversary of your event. I understand you're expecting a very good turnout today, 400 investors from around the region coming here. And I want to start with the big picture first because we are about 1.5 weeks away from Trump's inauguration. Markets are bracing for a lot of volatility this year. So where are your high net worth clients looking to put their money in this year?
So first of all, thank you for coming to our Asia Wealth Summit. Indeed, this is our 10th anniversary. It's a very big event for us. 430 investors, more than 60% of them are not based in Hong Kong. So we are happy to welcome them to Hong Kong. Now, yes, I think we are entering into a period of volatility, but at the same time, the macro environment is actually pretty robust, particularly in the US. For people in this part of the world, particularly in the ultra-high net worth asset owners segment, think they're very much focusing on how to diversify and hedge their risk in this part of the world, since many of them are entrepreneurs. So for them, actually, that diversifying into the US, into the high growth sector like AI, like healthcare, is critical for them.
Okay, so it looks like that US exceptionalism story is still very much at play here, but some are saying that the fact that S&P actually did really well last year, over 20%, and notched so many record highs, is that going to actually be a hurdle for us to see further upsides there? And also, are your clients worried about tariff risks at all?
I think that when we look at global markets, particularly in the US, is no longer as important to look at the index, S&P. I think within S&P, actually, that you have to distinguish between the high growth sectors and relatively speaking, lower growth sectors. If you look at the high growth sector, coming back to the what I mentioned about AI ecosystem, healthcare, and also digital asset, for example, those are super growth area, which I think can justify the valuation to continue to expand now. But on the other hand, you're absolutely right. Many of the relatively speaking lower growth sector, which benefit from S&P rating actually expansion, they might be at risk. Now, tariff, yes, it will affect many of the Asian companies, but at the same time, I would argue that many of the policies which is being pursued by the new administration will bring, perhaps relatively speaking, better political stability in this part of the world. So you have to counter both of the balances. But coming back, think about Asia wealth, where they want to send their money. Yes, for their business, they might actually that they have to think about the challenges of tariff. But for their own personal and family wealth, they can diversify away.
Okay, and we can't be in Hong Kong and not talk about China. And over the course of last year, we have seen foreign investors pull huge amounts of money out of China. And you add to that this year, there is depreciation risks as well. How are you advising your clients to position for China?
Well, I think when you look at the market, of course, you have to look at the economics, you have to look at company fundamentals, you have to look at valuation as well. Our view is that China is, at this point, very inexpensive, and I think the Chinese market and the Chinese policies are coming to the stage there where I think that we are bottoming out. But at the same time, when you think about investing, you have to look at relative opportunities. So yes, China is bottoming out as a market, but at the same time, from global investor perspective, the US is still providing better growth adjusted return. So therefore, I think opportunity cost-wise, I think that China will take a bit more time to attract global investors.
I want to speak a little bit about your line of business, because in the private wealth business, we have seen last year, for example, many banks going through restructuring and layoffs. Do you think we are at the end of that cycle now, and are you looking to hire this year?
I think the cycle or the secular growth of this sector, particularly in the ultra segment, is still very strong. In the affluent segment, is still very strong as well. So, but I think there is a observation of what I call the wallet concentration. I think over the last few years, I think investors have learned about the importance of counterparty risk, about focusing on large institutions. So therefore, when there is a crisis in the market and when there's incidents in the market, people actually stick to the larger players. So my observation, indeed, I think there has been some restructuring within the sector among some players, but I think the top 5, 6 players, global and local, I think are doing very well. But if you are the smaller players, subscale, it's actually quite difficult, despite the secular growth in this sector, to generate profitability.
So what are you looking at in terms of actual growth in assets under management, for example, not just in terms of valuations, but new clients, new money coming in?
Well, we are in a very, I think, fortunate position. We focus on the most important ultra high net worth segment in Asia. We have 140 RMs. I think most of them are very market savvy and very experienced people. I think help those clients to diversify their risk away from the region if that's what the clients want. Well, for us, actually, if we can grow from 140 to say 200 RMs in the next few years, I'll be a very happy man. I think in our segment, that's perhaps the right number. But I think for many of the other players, I think it is challenging in terms of justifying the cost expansion and trying to find the profitability.
So which market in Asia do you think is best prime for growth in terms of wealth? Just very quickly.
Without any doubt, Greater China region.
Okay, thank you so much. That was Vincent, Chui, head of APAC Wealth Management at Morgan Stanley. Back to you, Haidi.
I'll take it from here, Min Min. That was our China correspondent, Min Min Lo, at the Morgan Stanley Asia Wealth Summit in Hong Kong. Wildfires in California have killed at least 2 people and burned some of the wealthiest neighborhoods of Los Angeles County and forced tens of thousands of people to leave their homes. We can cross now to ABC News reporter Alex Stone, who's in Altadena. So, Alex, what's the latest?
Well, we just got an update that now 5 people are dead on this wildfire, with many more who have burn injuries that they were unable to get out early this morning and late last night when the fire was exploding. You can see behind me, firefighters have just really knocked down what was a raging house fire here, and they're having to do it with only one engine 116 there, that typically you would have many more engines battling a house fire, but they just don't have any more resources and no more water to give as they're waiting for help to arrive. This has been continuing to move, even though the winds have calmed down considerably since this morning when it made it so difficult for people to get out. Still, the fire has been moving from home to home and neighborhood to neighborhood, and many homes have been burning. So there is a lot of work left to go. Still, there is help arriving, coming in from other U.S. states that will be coming here to help out the local firefighters. But for now, it is a lack of manpower. They don't have enough engines. They don't have enough firefighters.
Alex, we're here in Australia where it is also wildfire season, but that's because it's high summer. Is this sort of condition that we're seeing in LA unseasonal, and how quickly could we expect it to ease and perhaps people start to go back to their homes?
Yeah, we're in winter right now. This should be the rainy season here in LA, and it is not. And so this is not normal, but there really is not one fire season here in LA any longer. It is year round. And so we do see fires in January and in February. But for something like this would be unusual at the height of fire season, let alone for this to be in the middle of January. This is pretty unprecedented in a number of different ways. The 100-mile-per-hour wind, it happening at this time of the year, people unable to get out. There are so many aspects of this that is not a normal fire here in LA. And firefighters, they say that there is no end to the fire season here in LA any longer.
Alex, you mentioned earlier that there is a water shortage as well. How much of this is due to drought? How much of this is due to poor planning?
Well, the last couple of years, this area had actually gotten a fair amount of rain and was doing quite well. But this is a dry year this year, and the rain from the last couple of years, it was not helpful in this because that caused a lot of the brush to grow high. And without the rain this year, that is now dried out, and a lot of that is burning. But this comes down not so much to, how dry it is plays a role, but this is really about how windy it has been. The 100-mile-per-hour winds this morning, there was no way that firefighters could stop anything in that kind of wind. It was incredibly dangerous, moving much faster than humans can run, and there wasn't anything firefighters could do.
ABC News reporter Alex Stone there joining us from Altadena, California. We appreciate your time, and please do stay safe out there. Another story that we're following this moment, and relief teams in Tibet have shifted their focus to resettling survivors of the earthquake that killed at least 126 people and injured almost 200 others. Tents, quilts, stoves and other relief items are being delivered to people whose homes are uninhabitable or unsafe. State media reporting that more than 46,000 people have been relocated. More ahead on the Asia trade. This is Bloomberg.
Well, let's take a look at how we're tracking on the ASX. The entire index is lower right now, but the worst performing stock is Star Entertainment, off a whopping 23%. The casino has been warning that it's just got $79 million left in cash, which is less than it spent in the past 3 months. It's struggling to attract customers and cut costs as well. Star said in a statement to the ASX on Wednesday that it spent $107 million in the 3 months to the 31st of December. Star operates casinos here in Sydney, Brisbane and the Gold Coast as well. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at what we're watching when it comes to some data just crossing the Bloomberg. Japan labour cash earnings, they're coming through a rise of 3% for November year on year, beating estimates of 2.7%. We're seeing real cash earnings falling, though, 0.3%, a little bit less of a decline than the over 0.5% fall that was being perceived by economists. Cash wages from the same sample seeing a gain of 3.5%, and the same base regular full-time pay at a gain of 2.8% there as well. So potentially when it comes to the same sample gauge that's closely watched by the BOJ, seeing perhaps a little bit of a surprise there and how the BOJ will potentially translate that. Wage growth, though, broadly accelerating in November. We had that annual increase in minimum wages and also just a broadly tighter labour market there as well. Bloomberg Economics saw an increase in cash earnings to really have picked up, and that is in fact what we've seen in these numbers as well. Adjusted for inflation, expectations was to see a little bit more of a wider drop from the previous month there. So really watching the sample changes, given that that is the measure that's preferred by the Bank of Japan, and sort of leads us as we continue to watch for what the BOJ's tightening strategy will be in the new year. Let's bring in our Bloomberg Tokyo economy and government reporter, Erika Yokoyama. So a bit of a mixed bag when it comes to the data. What will the BOJ be looking at, and the broader sort of takeaway from this lot of numbers?
I think today's data are fairly positive, actually, because they are in line with the BOJ projection. Nominal wages, base salaries, and other stable measures are all pointed to the same direction, steady wage growth, and they are beating the consensus as well. So I think this is an encouraging sign for the BOJ as it considers the timing of the next rate hike, including in January. And as you said, one concern is the real wages that keeps falling. But this time is particularly because it's due to the policy factor. The government halted the utility subsidy, accelerating inflation. But BOJ is also looking what's ahead, especially on development related to Shunto wage negotiation underway before making a decision.
Yes, so those are getting very near indeed. How are wage negotiations shaping up so far?
So I've got the impression that the negotiation so far has been quite positive. For example, like some large company, including retail giant Yoon or other life insurance companies, are proposing a 6 to 7% wage hike. But in addition to these early signs, apparently BOJ Governor Ueda wants to see some more one-notch compelling sign regarding the wage trend before making a decision. And actually, we can probably see some signs today as the BOJ is set to hold the branch manager meeting and also release a regional economic report. And we can probably see some further insight into the latest wage negotiations situation, especially at the regional level.
And it's, politically, it's an important agenda for Ishiba too.
Yeah, that's right. Absolutely. So Ishiba has repeatedly said the wage gain is one of his key policy focus. And of course, public satisfaction over economic state will definitely influence stability and longevity of Ishiba's minority ruling coalition, especially ahead of the upper house election in the summer. And Ishiba has already compiled the economic packages, which includes measures to support the wage gains, and also he's been meeting frequently with business and union leaders to amplify his call. So I think it's now time to see how these efforts have been received by the key players in wage negotiation as well as the public.
Bloomberg Tokyo economy and government reporter Erika Yokoyama there. Let's take a look at how we're setting up. It is looking like a pretty muted session for Japan when we get to the open in just under half an hour's time, as Nikkei futures look pretty receded at this point. Dollar yen has been kind of just been sticking around that same 158 handle that we've seen over the past couple of sessions. Potentially, though, the yen could be facing more pressure with the domestic sort of data points very much key here, as well as, of course, these changing expectations of what we could see from the Fed as well. So certainly watching JGB futures there as well. We could see a pretty volatile session. The earnings data that we just went through printing higher than forecast. We also have a potentially challenging 30-year bond auction to be pricing later today as well. Also a little bit from a former BOJ Policy Board member, Makoto Sakurai, saying that the BOJ will raise rates in March, putting it at about a 70% likelihood, but then expecting a slowdown over the next few years. So, Paul, still a great deal of sort of consternation as to how the Bank of Japan navigates this.
When we do get going in Japan, we'll be keeping an eye on Seven & I as well. Stock-specific story there. Third quarter earnings expected to show an operating profit declining 22% due to a weaker retail business, although we are expected to see signs of recovery in convenience stores in Japan and North America. The actual numbers, though, probably going to take a back seat to the broader backdrop, and this is Seven & I trying to fend off that takeover bid from Couche-Tard. Still no real firm plan on how to do that. Latest now from the corporate front. Bloomberg has learned Constellation Energy is close to acquiring Calpine in what would be one of the biggest ever deals in the power generation sector. Sources say the talks could value Calpine at about $30 billion, including debt. A deal may be announced in the coming weeks. Shares of Constellation plunged as much as 11% on that report before clawing back some of the losses. BlackRock says it's letting go of about 200 employees. That's about 1% of its staff. The job cuts are part of the company's efforts to realign resources, and it comes after it committed more than $25 billion for acquisitions to expand its reach in private market assets and data. The firm says the recent acquisitions will help them hire about 2,000 people this year. Tencent has repurchased the most stock in nearly 2 decades, buying back almost 8 million of its Hong Kong listed shares over 2 days. The stock has taken a hit since the Pentagon blacklisted the WeChat operator for alleged links to the Chinese military. Tencent has said it will work with the US Department of Defense to address any misunderstanding. Coming up on the Asia trade, fears that the standoff over South Korea's impeached president could turn violent as his supporters and security team shield him from arrest. We're live to Seoul next. This is Bloomberg.
Malaysia's second finance minister says the country's growth is set to exceed 5% in 2025 thanks to strong foreign direct investments and support from state funds. Speaking exclusively with Bloomberg, Amir Hamzah Azizan says Malaysia's new special economic zone with Singapore will benefit both countries.
It's important to recognize this was not an overnight thing, right? It's been something that both countries have been focused about building alignment, because the most important is to align, to agree that this is possible, and therefore understanding what are the complexities of making it work and what facilitation we can do. And the facilitation could be things in terms of agreeing priority investments that need to be done, facilitation in terms of easing the movement of goods that cross the borders, facilitation in terms of easing the movement of people across borders. And I think that investment that we all did in trying to get that alignment done eases the next stage. Yeah, but if not, it's an idea, then you suddenly run into bureaucratic blockages along the way. The second thing then is actually making sure that incentives which are given, they actually focus about the right things that we want to do. And we saw with the rollout of the GSEZ that tailor-made incentives are matching the desired growth areas in that segment. So in the GSEZ, they've broken down different zones that are prioritizing things such as logistics, manufacturing, digital, leisure and tourism, and all these things. So when incentives are given, they're not given blanket. They're given targeted in order to push that, because then you kind of coalesce the ecosystem in the right form along the way. So I think we've now put ingredients that will facilitate the quick realization of things along the way. And prior years of investments have also come to play, right? Malaysia's infrastructure, whether you talk about roads or rails, are getting better. The connectivity in terms of RTS is growing along the way, and it's building the ease of motion along the way. So, again, what's happened is that it's moved from paper ideas to fundamental infrastructure things that are really going to make things activated. So I'm confident that as this thing goes out, and the announcements are done, discussions are on the ground now to actually realize the first round investments come in.
But Minister, it is about return on investment. How soon do you think you'll see that return?
Well, I think if you ask people, how did Malaysia look at the data centers, for example, right? 5 years ago, it's very scarce, and I think. But today, Malaysia is enjoying the capacity, actually realizing the growth in data centers, because we have the availability of power, water, labor, space, and so on. So I think that conditions actually is being built up. And when we talk about the GSZ, again, move away from what we put on paper, but understand is the infrastructure, the zoning, the things are putting, facilitating that. And I think that base condition is the big change for Malaysia. And I think from a Singapore point of view, I think there are tremendous benefits whereby both parties can gain in terms of pushing segments of businesses in the right zone and helping complement each other to position both countries better.
And of course, jobs is a focus. 100,000 jobs, highly skilled jobs. How do you think those jobs can be filled? Is Malaysia prepared to fill those jobs?
I think Malaysia is learning along the way in terms of how to accelerate the building good talent along the way. The E&E sector has proven that we can do it. And so when we started in the 1970s, it was a new skill set, right? But over the years, we've added in TVET trainings, we've added in tertiary training and so on. We created pipelines of people that can serve the industry. Now we're trying to migrate that in terms of the same methodology into a JICZ sort of methodology, and we're putting incentives to allow facilitation. So if you see our knowledge worker incentive that we put in, a lower tax rate in order to attract knowledge workers to come to Malaysia in order to facilitate accelerated growth along the way. At the same time, commitment put in order to train locals to be able to support the businesses that are coming up.
Malaysia's second Finance Minister Amir Hamzah Azizan there speaking with Bloomberg's Haslinda Amin. You can catch the full interview at 11 a.m. Hong Kong time on Insight with Haslinda Amin. We do have some breaking news when it comes to these labour negotiation developments with US dock workers. The US dock workers union and port employers have reached a deal to avert a strike. That the parties' pact is subject, though, to ratification, but they have reached a deal to avert a strike. And this deal is in the form of a tentative pact for a new 6-year contract. We've seen sort of some of the details saying that this 6-year master contract with both sides agree on all items for this negotiation. They continue to operate under the current contract until that ratification, but very pleased, obviously, with the result. That's according to the International Longshoremen's Association. We had been expecting that meeting to come together for this new labour contract. That deadline was set for January 15th. That would have triggered a strike that could have halted half of the country's container volumes. We saw a point of contention being the use of semi-automated cranes at port terminals, but clearly a lot of these sort of issues have been resolved and a tentative pact has been reached. So really averting, Paul, what would have been some significant consequences for the economy, particularly as we've seen retailers already putting in place some contingency plans to minimise the impact on consumers and, of course, pricing and inflation.
Well, let's get to some other stories that we're following. The Chinese government has pledged to deepen its anti-corruption drive across a broad sweep of industries. And this is a sign that President Xi Jinping's campaign against corrupt officials will roll on for the foreseeable future. The nation's graft watchdog ended a 3-day meeting by singling out the finance, energy, tobacco, pharmaceutical, sports and construction sectors, as well as state-owned firms. Australian rents jumped about 7% in the December quarter. That's the slowest pace in 3 years. While nationwide prices reached a new high, the pace of growth is easing due to increased availability. Moderate rent increases are expected this year, helping put a Reserve Bank rate cut in play sooner rather than later. Now, in terms of that, we've got money markets pricing in a 70% chance of an RBA cut in February. That meeting taking place on the 17th and 18th of next month. This is after November inflation data did show some further easing towards the target band. We've got stocks a little bit softer today in Australia. The ASX off about 0.4%. Star Entertainment, the worst performing. It's really taking a beating, off by more than 23%. Due to a cash crunch. Available cash on hand for the casino operator now just $79 million. We've got a softer Aussie dollar as well, still holding on just above 62 US cents. We do have retail sales numbers and trade data for the month of November coming out soon, Haidi.
Well, Paul, we continue to watch South Korea, with investigators still trying to figure out how to peacefully bring impeached President Yoon Suk-yeol into custody after their first attempt failed. Yoon has been barricaded in his residence in Seoul, surrounded by crowds of supporters and armed security guards. Our economy and government reporter Sam Kim joins us now for the latest. And, obviously with the eyes of the world, Antony Blinken having recently just praised South Korea for the peaceful handling of this. Nobody wants violence or force here, but what are the options to try and get this kind of second attempt at executing the arrest warrant to be a successful one?
Well, it does seem like that it's going to be very difficult for the investigators to be able to detain President Yoon unless they resort to some form of violence, actually, because the presidential guards have fortified the walls of Yoon's residence with barbed wires. They've placed buses in front of the gate, and they've really ramped up the security around the presidential residence. And, the only way for Yoon to ever respond to this type of arrest warrant would be if he's formally indicted, or if there's another court that issues a more stronger, an extensive form of arrest warrant for him. That's what his lawyers say. But for the time being, I think there's a lot of tension at the residence with pro-Yoon protesters and the presidential guards trying to block any attempt by the investigators to detain Yoon.
What are the chances of a tougher arrest warrant being issued? And in the meantime, what are the risks to Korea's reputation as a democracy?
This is certainly a test for Korea's democracy. There's no question about it. At the moment, there is a separate court proceeding going on with Yoon at the Constitutional Court, deliberating on the impeachment motion that was passed against him last month. And then there's the what they call the corruption office investigation that is going on separately against Yoon. Who are the people that are trying to detain Yoon for questioning on what happened on December 3rd when he declared martial law. So there's essentially two proceedings legally that are happening. Now, this is something that has never been seen in Korea before, even though Korea did see two previous impeachment rows happening in the past 20 years. This is something just so unprecedented that even the lawmakers, the legal experts themselves are just questioning every step of the way whether what's happening is something that's valid, whether it's something that is legally possible. So there's a lot of questions about what's happening, and it is certainly a moment of test for the authorities and the Korean democracy and everybody else watching it as well.
Economy and government reporter Sam Kim there. We have more ahead on the Asia trade. This is Bloomberg. Panasonic says it's making big investments in North America as it prepares for the second Trump administration. We asked regional CEO Megan Mangwon Lee about the company's AI plans after its acquisition of supply chain software provider Blue Yonder.
As a 106 years old company, and we're making big investment in North America in the area of energy for EV batteries. But supply chain is also a critical part of our business and the area that we're trying to make a contribution for a more efficient, smart supply chain solutions. So we bought Blue Yonder, and Blue Yonder is coming out with a end-to-end visibility capability with AI agent. They can customize for your problems and solutions and can work with you. So we're really excited about that announcement.
What kind of a deal was that? How difficult was it to get done? You know, like the story of 2024 was companies, industrial companies in particular, going out and saying, we're either going to have to acquire capabilities or we're going to have to grow them internally. You went one way.
Yes, yes. So we started working with them a couple of years ago, and we're really excited about their our ability and investment that we made with Blue Yonder and their capability to really solve the problem of the supply chain resilience and safety, and will be the forthcoming with the newer technology, and we're really excited about that. So it's a Blue Yonder subsidiary of Panasonic, and they're in North America based, and it's a great announcement for us and newer capability for us.
You said two things, supply chain resilience and investing in America.
Yes.
And I post on social media every year that I'm going to be speaking to you, and every year I get dozens of questions, hundreds actually in this case. I would say the vast majority are about the upcoming Trump administration and potential tariffs and policy around China. And that's so interesting to you because of the EV battery supply chain in particular in this country. What's your message around that?
So even before the Trump administration, the supply chain, I mean, we all know that China controls a lot of raw material. We had
raw
our
material being lithium,
for the for the EV batteries. Yes. So we've been working hard even before. I mean, during COVID, everyone had the challenge of managing supply chain. So we had that issue of trying to make sure that the supply chain is smooth and predictable and under control. So we have vested interest to make sure that it's closer to the production being Reno and newer factory in Kansas, which is opening up this spring.
Panasonic's North America CEO speaking there in Las Vegas with our Bloomberg Technology co-anchor Ed Ludlow. Coming up on the Asia Trade in the next hour, we'll be back at the Malaysia Economic Forum for an exclusive interview with the Maybank President and Group CEO, plus AXA investment managers will be along with us to give us their outlook when it comes to the Fed. The market opens in Seoul and Tokyo are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens and the inflation sort of play across the world, not just, of course, what we're watching when it comes to the Fed and the jobs numbers that are expected towards the end of the week and how we are seeing that fair degree of caution there and potentially a slowdown in how they want to be easing according to those minutes. But, of course, also China, where it's a much different picture. Inflation pretty much projected to be at zero. Are they already in this deflationary spiral?
Yeah, well, that's the debate of the hour, isn't it? The Japanification of China, and have policymakers done enough to break their way out of that? Well, we'll have that data a little bit later on in terms of the deflation picture. But you're quite right. The inflation story, meanwhile, in the US appears to be live and well, although we did hear from Chris Waller saying he wants to continue with easing.
Very interesting as we head into the start of trading across Seoul and Tokyo. In Japan, we had some pretty encouraging base pay numbers, at least. In fact, base pay rising the most in 32 years. Broadly speaking, it was a pretty positive sort of out-of-the-box beat for those Japan cash earnings numbers. We saw a little bit of a boost to the yen in sort of the wake of that data being released. And we're also watching, of course, what happens when it comes to JGBs today. Potentially some pretty challenging pricing for a 30-year auction coming up as well. So So the Nikkei 225 lagging a bit as we get online. Broadly, it is a bit of downside across the Asian session as there is sort of muted appetite for risk at this point. But potentially, we're really just looking ahead to what the Bank of Japan do, given this sort of supportive rate hike outlook with the cash earnings numbers. In the inflation sort of adjusted numbers, we saw a drop of 0.3%, but there's now, just shy of a 50% hike at the January meeting, depending on further data on wage growth sustainability. We're waiting for the wage negotiations. That could be something that they're waiting for instead. Dollar yen unmoved at this point, 158, a little bit stronger for the yen there, but still within that window that we could see really still further pressure. And if there is sort of this choice to wait until where the Bank of Japan goes and those Shunto wage negotiations, we could see those bears still very much in control there. But taking a look at Korea, where we're seeing a little bit of upside there for the KOSPI, up about 0.1%. The political situation continues to kind of be one that we're watching, right, because we know that there is an intended second attempt to arrest President Yoon, but this ongoing sort of standoff continues, and they certainly want to try and achieve that within, be able to do that sort of peacefully and in a stable manner without a force or violence. But this situation and the sort of deepening political divisions in Korea continues to drag on there, Paul.
A bit of a risk-off sentiment here in Australia as well. The benchmark index off by about 0.2%. Now, as we mentioned, Star Entertainment in particular taking a beating, the worst performing stock. Long story short, it's running out of money. We've got some data coming out of Australia as well at the bottom of the hour. It's retail sales, trade data for the month of November. The consumer's in a bit of a dark spot here in Australia as well with persistent inflation, although yesterday's CPI numbers for November were fairly encouraging. We've got money markets now pricing in 70% chance of an RBA cut in mid-February. Take a look at yields in the US. Meanwhile, they are recovering. Well, US Treasuries have recovered somewhat. The 20-year did briefly touch 5%. It's going to be a choppy day of trading tomorrow for US Treasuries cash market, closing early, futures closing early as well. It's a national day of mourning for former President Jimmy Carter. Well, let's get back to Morgan Stanley's Asia Wealth Summit now in Hong Kong. Our China correspondent Min Min Lo standing by with our next guest. Min Min.
Hey Paul, joining me here is Chris Iggo, CIO for Core Investments at AXA Investment Managers. Chris, really great to see you here in Hong Kong. Very short trip that you have here. I just want to start with what's happening in the US because we're getting the December employment data tomorrow, and we have seen bond yields spiking and traders really stop pricing a rate cut in the first half of the year. What are your bets on the rate cutting cycle this year, and where do yields go from here?
Thanks. Good morning. Thanks for having me. Well, we officially expect just one rate cut in the first half of 2025. Okay. But there's not a lot of conviction around that view because there's so much uncertainty in the outlook. And we really need to see what the Trump agenda is and what specific policies are going to be implemented by the new administration. The backdrop is, of course, that the US economy is quite strong. Yeah. Inflation is still above target. The labour market is slowing down, but it's still quite strong. And it makes sense for the Fed to be more cautious. But I suspect that as we go through the year, there may be a case for more rate cuts to come.
Okay, you talk about Donald Trump, and we have to talk about his tariff policy because that affects inflation and what the Fed would do. What is your base case scenario for his tariff policy and how that would impact markets?
Well, again, there's a lot of uncertainty because what's been threatened by Trump isn't necessarily what will be implemented. And if we look back to the previous Trump administration, actually the tariffs that were put in place were relatively modest. However, if he does go all in and puts tariffs on as he's been threatening, then that will have an impact on inflation in the US because those tariffs will be passed on to consumers. And that makes the Fed's job even more difficult. But more importantly, I think, is the effect on world trade because other countries could retaliate and that may impact on trade volumes everywhere. So what Trump does with China, what Trump does with Mexico will be very important for trade flows and very important for the global manufacturing sector, which has been quite weak already. And this is one of the biggest threats, we think, to global growth over the next couple of years.
Okay. What is your outlook then for U.S. equities? Because I think you were the one who said that we have seen how the S&P had over 20% annual growth the last 2 years, and you said a third would be a stretch.
I think it will be. It's always what earnings do will be important. So earnings expectations are still quite optimistic. I think something around 14-15% earnings growth is expected for the S&P, which if the economy continues to grow as it is at the moment, then that is feasible. But my caution is around valuations. The S&P is expensive. When we look at any kind of valuation metric, it's at multi-year highs. And if bond yields keep on going up, as they have been doing since the beginning of this year, that we think is a threat to equity valuations. Yeah. Because bond yields at 5% potentially in the next few weeks could be a major threat to equity valuations.
Yeah, and when you think about how the Fed could possibly be pausing on rate cuts, that sort of also limits other central banks' ability to cut rates and stimulate growth as well. So where else are you looking for opportunities beyond the US?
Well, I think there is a divergence between what's happening in the US and the rest of the world, and rate cuts are much more likely elsewhere, particularly in Europe, where we think the ECB will cut rates to below 2%, which is needed because the European economy is quite weak. We do see opportunities outside the US in fixed income markets, particularly in Europe because of the rate cutting agenda, even in the UK where rates are still too high for the economy. And in emerging markets, I think we need to be selective because the tariffs could be a problem for some countries. But interest rates are likely to come down in a number of emerging market economies, particularly in Asia, because of what's happening in China. And we see again opportunities in fixed income, but also in some of the tech-related equity markets. So markets like Taiwan, we think, will continue to perform well.
And let's talk about China because it's really at the center of this geopolitical tension between US and China. How are you positioning for China?
Well, we're not, I think, at the moment. That's the truth of it, because there's a lot of uncertainty still on the growth outlook. When we look at what's happening with Chinese bond yields, it tells us there's a deflation problem in China. And for that to be corrected, we need to see more stimulus coming from the Chinese government. Now, we've had some attempts to stimulate the economy, but the real challenge is to stimulate consumer spending, and that may take some time. What we've noticed is that Chinese consumers are responding to lower prices and they're spending, but they're not spending on real estate, they're not spending on equities, they're not spending on big ticket items. And I think there's a lack of confidence, and we need to see more efforts from the government really to stimulate that kind of spending.
Okay, so which equity market do you think will do best in 2025?
Well, despite what I said about the US, I think you have to bet on the US remaining the strongest equity market. There will be more volatility, I think, but all in, I think the returns from the US will continue to be strong, led by tech. Elsewhere, we think Europe should do okay because earnings growth is lower, but there's a healthy dividend yield in European equities. And then we would look selectively at emerging markets. I think for China specifically, for the stock market to perform, it really needs consumer confidence to improve, and then that again goes back to the government stimulus measures.
Yeah, it's probably going to take several years for that to happen. Thank you so much, Chris Iggo. That was Chris Iggo, a CIO for Core Investments at AXA Investment Managers. Haidi.
Our China correspondent in Minlo there at the Morgan Stanley Asia Wealth Summit in Hong Kong. We do have some breaking news when it comes to SoftBank as well. ARM is said to be exploring an Ampere Computing takeover. We hear that this is kind of the exploration of a deal to acquire Ampere Computing LLC. This is a semiconductor designer which is based off ARM infrastructure as well. It's really drawn takeover interest from ARM. It's exploring strategic options with a financial advisor. And of course, this deal would just add to the wave of chip companies really capitalizing on the AI spending boom. It would give ARM expertise and impetus in this market. But Ampere, which is backed by Oracle, the semiconductor designer, has really drawn a lot of interest from ARM, but these discussions are private and ongoing. Our sources say that these talks could still fall apart, and also given there is so much interest, it's also possible that Ampere could end up being bought by another suitor, since it flagged itself as being open to such an acquisition. Neither ARM nor Ampere have agreed to comment, and spokespeople for SoftBank and Oracle also haven't immediately responded either. But we did report back in September that Ampere was working with a financial advisor to help field takeover interest. And Paul, that was valued at $8 billion in a proposed minority investment by SoftBank back in 2021. So we'll kind of keep an eye out as to what sort of valuation they're now discussing.
All right, still to come. We will be live at this year's Malaysia Economic Forum for an exclusive interview with Maybank Group CEO. He'll be joining us a little bit later on. First, though, the Biden administration planning a parting shot at China on chips, extending restrictions on the export of AI equipment. Details next. This is Bloomberg. The Biden administration's planning further restrictions on the export of AI chips from the likes of Nvidia and AMD in a final push to keep advanced technologies out of the hands of China and Russia. For more, let's bring in Asia Tech reporter Annabelle Drewlers. So, Annabelle, the world divided into 3 tiers. How are these restrictions going to work?
Yeah, so this is what we're hearing from sources, but essentially the Biden administration could roll out this system by the end of this week. So as you said, we're hearing that it's going to be in 3 tiers. So the first tier is the US, its closest allies. So you're thinking about US, Japan, Korea, Taiwan, Western Europe, Australia, others. But you're essentially giving this group of countries and companies that are headquartered within those unrestricted access to American technology. The third tier, as you can imagine, is the most restrictive. So you're thinking about Russia, China, parts of the Middle East like Iran, Iraq and Afghanistan also fall into that category. So they're going to have the most punitive restrictions. And then the second tier is where it's pretty interesting, because this is really the rest of the world. But countries in Central, Southern America, large parts of Africa, India, across Asia, they're all going to need to essentially speak with the US government and get what's called VEU, or validated end user. So if you're a country or a company in this tier 2 category, of course, if it does eventuate, because this is according to sources at this point in time, but essentially you can get higher caps on the amount of advanced AI chips that you can access, because we're talking about chips that are used and put into AI servers. You can get greater access to those if you can meet certain requirements, and that includes having, for instance, a demonstrated track record of engaging with US government officials or meeting human rights standards, or at least you need to have some sort of credible plan for doing so.
And unsurprisingly, opposition from Nvidia.
Yeah, which of course you can expect that, right? I mean, essentially what Nvidia is saying is just don't move too quickly on this. They're saying that if you have any sort of last-minute rule that restricts exports to the most of the world, that's going to be a really big change in policy, and it's going to really, of course, increase the amount of risk of misuse, and that could, of course, as well threaten US economic growth. That's the argument that Nvidia is making, and they're saying that there's just so much interest in their products that they're getting from around the world, which of course we know. But the market reaction to it, well, Nvidia did slip a little bit in after hours following the reporting of this. AMD as well, that declined, but just less than 1%. Still, though, the Semiconductor Industry Association is saying that a policy change of this sort of scope, this sort of significance, shouldn't be rushed out the door in the final days of the Biden administration. But we do know that there is sort of bipartisan support for a more hawkish stance on China, and many in Congress would say that this is sort of a once-in-a-generation opportunity to leverage US AI technology and also to pry some companies and some countries away from Beijing.
Our Asia Tech reporter Annabelle Drewlers. And of course, China has economic problems of its own. On top of the geopolitics, we'll be getting the December inflation numbers in the next hour. Economists expect CPI to have weakened closer to 0 This could signal more government stimulus is needed to counter deflationary risks. Bloomberg's Chinese economy and government reporter James Mager joins us now. So, James, sort of harkening back to yesterday's big topic and piece on the Japanification of the Chinese economy. This has been discussed for a long time. What's kind of changed, and are we meaningfully closer to that deflationary spiral and confidence, trap that, as we see from Japan, is very hard to get out of?
I mean, if you look not at the CPI numbers, but at the producer prices, which I think are what's really important for driving, inflation across the economy. China's already in deflation, and there is no sign that it's getting out. I think December will be the 27th straight month that producer prices have fallen. This is the longest streak since the mid-90s. And there is no sign that that's going to turn around this year. We expect that, and economists that we speak to, we survey, expect that producer prices will be negative all of this year, and the GDP deflator, which is the broadest measure of inflation across the economy, will also be negative this year. And if that does happen, it'll be the longest streak of deflation in China since the 60s. So, China is already in a deflationary environment. And people are shopping and people are consuming based on those expectations. The prices will continue to fall, and that will flow into wages. Wages will continue to fall. Investment will continue to fall, or people will pull back on investment because of those things. So, it really is already in that. I sort of have some issues with the Japanification idea, but I do think the idea, the deflationary mindset that the BOJ spoke about a lot, is what we're seeing here. I don't think that the comparison with Japan and China is a one-for-one comparison, but the idea that people will base their shopping and their consumption on the expectation for future price falls, which is what the BOJ was trying to fight against for many years, is really what we're seeing here now. And you're seeing some of similar, effects. For example, the shopping chain, the restaurant chain, Saizeriya, which is a Japanese chain, which has like Italian food, is become really popular in China because prices are really low. And it was exactly the same in Japan in the 90s and the 2000s. Saizeriya was really popular in Japan because prices were low and people could eat there cheaply. And so you're sort of seeing the same kind of effects, even for the same companies like Saizeriya, where people are shopping, but they're shopping cheaper. They're going out, on holidays, but they're going closer to home. They're not going overseas. They're doing cheaper holidays, those kind of things. So I think already that deflationary mindset has set in, and I think the data today is just going to confirm that continued through December, and it's likely to continue into this year.
Well, we've seen some policy from the government so far to address this, but as this problem deepens and really becomes psychological as well, when do we reach the point that something much more vigorous is going to be expected from policymakers, and what's the chances we'll see it this year?
The real big problem is that, at least for the producer price side of it, or the manufacturing side of the economy, is that there's massive overcapacity in many, many industries. And that's partly due to the housing market slump. It's partly due to other things, just overinvestment into various different sectors. And until those problems are addressed, until there is a real reduction in steel production, glass production, cement production, solar panel production, these other things, prices are not going to rise. There's too much supply, there's not enough demand, and so therefore prices fall. And the government is talking about doing things to solve that, and gradually at the edges, a little bit here, a little bit there, but it's not been a real drastic, there's not been real drastic measures so far to do that. And demand isn't picking up, enough to mop up that excess supply. So until we really see something that is going to cut into output of all of these things that there is too much of, which is what's driving these price falls. There's little chance of this turning around. The problem is, though, that if you start slashing output of steel, you start slashing the need for steel workers. So therefore, this comes with further economic problems that has to be dealt with. But for the price for inflation or deflation, we're not seeing anything really that's going to change this picture drastically.
All right, Bloomberg's Chinese economy and government reporter James Mager there. Coming up, we're going to get the outlook for Japan's busy M&A scene as CEOs express concerns over the blocked merger of Nippon Steel and US Steel. This is Bloomberg.
The fact is, a country that was once the pride of the world for its free competition with no political intervention has now become entangled in politics. when that happens. I think that not only US Steel and Nippon Steel, but also other Japanese companies will be hesitant to do things like this for fear that politics will get involved again. This is not good for the Japanese economy.
I think that this is ultimately a political deal. And if we call it a deal, I think there is a good chance that Mr. Trump will reconsider. I think there will be both positive and negative impacts. When a country as powerful as this takes action, there is no way that it won't have an impact. So it is necessary to prepare for that as well. And I think that most of the companies in Japan today are to some extent prepared for that.
We are still willing to invest to the United States, despite the fact that the Nippon Steel and US Steel issue, which is still going on. But we are willing to be in part of the US economy. It's disturbing that the US Steel and Nippon Steel deal will be broken because we believe US is the best ally for us too. So there is a goodwill between the two countries.
Japanese CEOs commenting on Washington's decision to block the Nippon-US Steel deal. Japan's dealmakers are expecting a busier 2025 after more than $230 billion in mergers and acquisitions last year. Bloomberg finance reporter Lisa Du joins us now for more. So, Lisa, what's driving this M&A boom?
Morning, guys. Yes, last year was a super exciting year for Japanese M&A, about $230 billion US in transactions, some of the highest growth pace we've seen since 2018. Now, Japan's always been quite active for M&A, but when we speak to bankers, lawyers, deal makers, they say that this kind of deal making is now becoming more dynamic, more diversified. And what's really driving that is a changing mindset at Japanese corporations when it comes to kind of telling their growth story and paying attention to their share price. So Japanese corporations are realizing now, they're trading at low valuations. They don't have enough of a good growth story. They become targets for active investors who, will come and take a stake in their company and make public bids for change, or they can also become the target of global rivals that might come and try to take over the company. And so what they're doing now is, they're being more proactive. So Japanese companies are being more proactive about growing their business, whether it's overseas M&A, or what we're seeing at an increasing trend domestically is that some companies are opting to go private instead, or even maybe sell off more of their non-core businesses. All of that really driving the deal making here in Japan.
What else are we expecting this year?
Yeah, and so basically, I think some of these same factors will definitely continue to play out from the people we've spoken to. And, and also you look at some of the really prominent ongoing deals that's going on right now, and they all kind of adhere to this theme of Japanese companies, being more proactive about growth. Nippon Steel suing U.S. officials, to keep their deal for U.S. Steel going, which is a bid for bigger, greater global growth. You look at 7-Eleven, which is kind of now become the target of a global rival, Custard, in a bid for growth, and also kind of Nissan, Honda now formalizing their merger talks. All of these things, going into 2025, something we'll definitely keep an eye on, and we should expect more of these types of deals going into this year as well.
Bloomberg's finance reporter Lisa Du there. More ahead on the Asia trade. This is Bloomberg. Well, Malaysia's annual economic forum is beginning today. Before we get to that, let's bring in some of the data that we're just looking at the moment when it comes to retail sales. In Australia, this is a picture with November retail sales rising 0.8% month on month. That is slightly softer than estimates of 1%. And this comes off what was sort of a pretty strong number in October as well. It was an excess on forecasts and a third straight month of gains. So we are still seeing those gains, perhaps a little bit less exuberant than expectations. The December numbers will also be quite key. But of course, November is sort of when we almost start to see more of that spending given Black Friday and some of the pre-Christmas retail activity as well. So we have seen that strength in non-food industries, household goods, alcohol as well, seeing significant increases into the end of the year, Paul.
Getting trade numbers for the month of November as well. Very strong beat here. the trade surplus just over 7 billion Australian dollars. Exports are very strong, rising 4.8%, a big increase on the 3.6% that we saw the month prior. Imports, meanwhile, also rising by 1.7%, but the trade surplus substantially larger than was anticipated by about $1.5 billion, Haidi.
Yeah, we're seeing the Aussie just extending the decline there after that data. Let's get to Kuala Lumpur, where, of course, Malaysia's annual economic forum is beginning today. Policymakers, business and finance leaders gathering to discuss Malaysia's priorities and policies for 2025. Our Bloomberg Insight anchor Haslinda Ahmed is there for us.
Well, Haidi, it is the first economic forum here in Malaysia, well attended. They're expecting more than 3,000 participants, and you can understand the interest in the economy. What a turnaround story, 5% growth. And when you take a look at the currency, well, it was the best performer in 2024 after a lackluster start to the year. So quite a turnaround story, a lot of interest. And of course, this is coming on the back of Malaysia and Singapore also signing an agreement to develop a special economic zone in a state called Johor, which is a border that they share. Well, let's talk about what's in store for the country and companies here. Joining us exclusively is Khairussaleh Ramli, President and Group CEO at Maybank. Good to have you with us. Our first conversation.
Thank you.
Let's start with the economic zone. I mean, there's a lot of buzz, there's a lot of expectations, big ambitions, big numbers there, 100,000 jobs to be created, $26 billion to be added to the Malaysian economy. How are you looking at it as a bank?
Thanks, Haslinda. But let me just start with why we are here today, right? Maybank is today the principal sponsor for this event. We are bringing the government and the ministers basically to talk about the achievements in the last 1.5 years or so since the Madani economy was introduced, and of course for them to be able to showcase what they're going to do next, right, to again continue with the economic growth. Now back to JSSEZ. I think when we look at the announcement, what we saw there was things that are quite holistic, in terms of identifying specific industries in 9 economic zones. And this is not just about attracting investment in. It's also about trying to create jobs. It's about trying to improve infrastructure, right? And again, it's about trying to maximize the synergies between Singapore and Johor. So I would say that this is quite holistic, and of course, we look forward to about how the blueprints are going to come out for the implementation.
As it stands now, what role do you see Maybank playing? I mean, do you see perhaps bringing funding to Johor, for instance?
Maybank, we have been very active in the several months before the announcement in taking the Chief Minister of Johor and even some federal ministers to be talking to investors, to be talking to the relevant stakeholders in terms of promoting JSSEZ, right? Now, in Johor, we have got 37 branches. We have got 8 business centers. In Singapore, we have got 18 branches and we've got 7 Premier Wealth centers. So, if we can optimize the presence that we have through the footprints, making our clients and investors and customers to facilitate them to come to Malaysia easily, in Johor, and make it, like a one-stop center, right? From advisory, from financial solutions, from transactions, right? So we think that we are in a good position to help our customers and investors to be able to do that.
But let's put a number to it, right? When you take a look at pipeline growth, for instance, how much is due to the agreement between the two countries?
You see, I think we need to also look at the potential, right? Because at the moment, what has started at least are data centers. Right? These are real numbers that are coming, right? But of course, then the government has also said that they're going to look at manufacturing, AI, and high economic value industries, right? So to put a number now, I think even the government doesn't have that number. But what they have started with at least is to say that in the next 5 years, they're going to look at 50 projects, right? In the next 10 years, they're going to look at 100 projects, right? And hopefully they're going to look at the high impact areas, right? Based on what the economy needs. And the other part is that they have also said that they want to create 20,000 jobs, right? From this thing. So to me, those are the high level numbers that then we can work towards in terms of looking at our own pipeline.
So how are you looking towards that now that the government has come up with some of those numbers?
So we look at a few industries. One is renewables, right? In terms of looking at energy transition, we know that Singapore has got that requirement for renewable energy, and we know that Johor, and in fact Malaysia, can become that supplier. So energy, renewable transition is one thing. We also look at the high economic growth against semiconductors, etc. So we are quite targeted in a few sectors: transition, sustainability, the high value economy, and even halal. I think there's big potential for halal as well. Yeah.
So we're looking at the growth in Malaysia against a very uncertain backdrop. Trump policies may have an impact on a country like Malaysia, which is export dependent. I mean, how are you looking at the impact of Trump, and are you already seeing the impact on Trump on things like deposits, for instance?
Well, we have not seen the impact of Trump yet. Of course, he's still not in office. We believe that we do need to look at the impact. Of course, 12% of our trade is with US as a country. So whatever they do from that side will have an impact to us, right? But at the moment, I think it's more in terms of look and see in terms of what will come out from this particular thing, and of course we will advise our clients accordingly. To your point, we have not really seen any material or any effect at all on deposit and financing.
Do you see an impact on the country? I mean, we've seen a turnaround in growth, for instance. We're talking about 5% growth. We have the country beating its budget deficit, which is a positive development. Might Trump policies impact?
It's possible. I come back to the point where, inevitably, 12% of our trade is in the US. And if there's, policy on additional tariffs, additional tax, right, that will have an impact on us. So, we'll see.
For Maybank, any implications, for instance, on its growth strategy? Are you looking at acquisitions? What would make sense for you?
For now, we are looking at just realizing value from our current organic footprints. We still think that there's value in Malaysia, Singapore, and Indonesia, as well as we're trying to realize additional value, say, from Vietnam, Cambodia, and Philippines. So our focus will obviously be on wealth. On the corporate side, in Malaysia this year, we're expecting growth of loans to be around 5.5%, and primarily from non-retail, non-individual, so the corporate side, right? And again, with the investment coming in. So we think that part of the business can help us grow quite materially this year. On the investment banking side, the pipeline is still strong, the market is good, right? So it's conducive for people to do transactions on the stock market and the capital markets.
But you're facing competition. We have the likes of DBS, wanting to make acquisitions here in Malaysia. Are you game? Are you set? I mean,
competition is good. We have actually Malaysia, if you notice, has been very open from the banking landscape, right? We've got more foreign banks than local banks, and the local banks here the foreign banks here are sizable, right? So you're right. I think there will be an eye on all this competitive landscape. But we're game for it.
But what's the strategy then to counter the competition?
Well, I think our concept is simple, right? Our concept is basically, as long as we stay close to what the customer needs, right? And the customer cuts across all segments, right? And we just need to focus on the segments that we think we can grow, right? Wealth again, SME, and even corporate, especially the mid-cap, For Maybank, for the longest time, we have always focused on the large companies, right? Because we are big. But we have a sizable pool of the mid-cap companies that we haven't really penetrated. They are already clients, but maybe just from an opening transaction account. But there are so many other solutions that we can offer across the platform that we have.
Khairul, your Maybank is the largest bank in Malaysia by market cap, but some people take issue with your ROE. They say return on equity isn't as good as when you compare to the average bank in ASEAN. I think it's 11% versus 14%.
Yes.
How do you make that better? How do you improve that?
Well, again, we acknowledge that we have got room to improve our return on equity. In fact, we want to pivot more on ROE, right? So last year we should hit 11%. This year we think we can do much better.
What is much better?
Well, we'll come back to you when we announce our full year results. So again, it's focusing on the non-interest income side. So if you look at our income last year, at least for the 9 months, our non-interest income actually grew 30-odd%. right? And this came from particularly wealth, from our global markets, especially on sales, right? And of course, investment banking, right? So again, we, with our customer base, right, we believe that we can do better in penetrating our customers beyond just lending. And that is a significant uplift on ROA, we believe, ROE.
All right, Carol, we'll have to live with that. Thank you so much for your time today. Khairussaleh, Ramli, President and Group CEO at Maybank. Of course, we're coming to you live from the Malaysian Economic Forum, the first one they're hosting to take stock of what's happened in 2024 and also to set the agenda, the priorities for the year ahead. Paul, handing it back to you.
All right, thanks, Haz. That's our Chief International Correspondent for Southeast Asia, Haslinda Amin in Kuala Lumpur. The latest stories now that we're following from around the world. Uncontrolled wildfires still burning through parts of California, fanned by extreme winds. The fires have killed at least 5 people and burned some of the wealthiest neighborhoods of Los Angeles County and forced tens of thousands of people to leave their homes. The disaster could be among the most expensive in U.S. history. Unions representing U.S. dock workers have reached a tentative agreement with port operators for a new 6-year contract, avoiding a possible strike. The two sides will operate under the current contract until the union and port employers can ratify the terms. Nearly 200 large union contracts are set to expire this year, covering more than 1.5 million workers across multiple industries. Australian rents jumped about 7% in the December quarter. That is, though, the slowest pace in 3 years. While nationwide prices reached a new high, the pace of growth is easing due to increased availability. Moderate rent increases are expected this year, helping put a Reserve Bank rate cut in play sooner rather than later. The Chinese government has pledged to deepen its anti-corruption drive across a broad sweep of industries. It's a sign that President Xi Jinping's campaign against corrupt officials will roll on for the foreseeable future. The nation's graft watchdog ended a 3-day meeting by singling out the finance, energy, tobacco, pharmaceutical, sports and construction sectors, as well as state-owned firms. Haidi.
We have seen that increased support when it comes to China's support of the yuan, as the yuan continues to head towards the policy red line. But it's not just a yuan, although it should be feeding off some of that EM weakness, as well as sort of vice versa as well. We've seen that pressure on the deepening EMFX sell-off there. Broadly, we're seeing emerging market assets falling on Wednesday. Increased bets on a more hawkish Fed, concerns over President-elect Trump's tariff plans and further geopolitical tensions there. The MSCI EM currency index dropping about 0.3%. Most developing economy currencies are looking weaker against the dollar. Stocks also falling, snapping that 3-day gain. And really, it is sort of awaiting clarity on a Trump administration 2.0 policies. There's a lot of favorism for the dollar at the moment as a haven amid an increasingly unsettled outlook, and of course just the dollar exceptionalism, Fed and US economy exceptionalism that we saw play out through most of last year there as well. So we could expect to see a further sell-off going into the inauguration on January 20th there. We did have that report that President-elect Trump is considering declaring a national economic emergency to push through his tariff plans. All of that is just adding to even more investor concern.
Well, let's take a look at LG Energy's shares slipping after the company reported a surprise loss of 225.5 billion won. The expectation was for a narrow 16.3 billion won profit. So a shock loss reported there in the fourth quarter from LG Energy. Also reporting there a miss on sales. But that operating loss coming as something of a surprise. LG Energy shares down more than 2.4%. More ahead on the Asia trade. This is Bloomberg.
Whatever the administration ultimately decides, we'll give them as much insight as we can from our perspective. And I'm sure that the administration will make the right moves. That's in the best interest of our country.
Nvidia CEO Jen-Hsun Huang speaking with Bloomberg a little bit earlier this week. And of course, since then, we have had really this final push in the last days of the Biden administration to limit Nvidia's AI chip exports. We're hearing that the plans are to impose new restrictions on these artificial intelligence chips, really aiming to keep these advanced technologies out of the hands of the likes of China and Russia. So these so-called sort of 3 tiers of chip curbs, with a small number of allies having unmitigated access and then sort of gradually becoming more restricted from there. Let's get some analysis now from Bloomberg opinion columnist Catherine Thornberg, who thinks that the US needs to clarify the links between these consumer tech companies and national security. Catherine joins us now with more. So, you know, there's a huge lack of clarity in terms of some of the decisions that are being made. Is that what concerns you?
Yes, Haidi. So I think if you look at Tencent, which was just added to the Pentagon's blacklist, you know, we don't have any information about what exactly its links to the Chinese military are. And we've sort of seen this show before. I mean, when Xiaomi was added to the blacklist back in 2021, they sued and they eventually got themselves removed from the blacklist. But the evidence that came out against it, the ties to the Chinese military, were that it was investing in 5G and AI, which pretty much everyone's doing. And also that its founder had won a sort of government-linked award that so many other entrepreneurs had won, including the makers of sort of a chili sauce brand. So I think when we just throw around national security so broadly, it sort of starts to lose its meaning. And I think that the U.S. government would be wise to really be a lot more strategic and clear about what it means there.
So is Tencent going to be able to pull this off? Is it going to be able to get itself off that Pentagon blacklist?
I think so. I think, you know, like I mentioned earlier, as we've seen with Xiaomi, they were able to remove themselves from the blacklist. But, you know, the hit to the reputation is already there. And Tencent is another one of those companies that has its arms in so many U.S. firms. So I think when the U.S. is, you know, coming after these Chinese consumer-facing firms, throwing around national security, I think it can spur sort of Beijing's ire, and it doesn't necessarily accomplish a lot, especially when these sort of blacklists don't necessarily come with, you know, actual penalties and sanctions.
So we don't know what President-elect Trump is going to do. Sometimes he does what he says, and sometimes, you know, execution is very different to the campaign rhetoric. But what do you think the incoming administration should do to avoid, you know, a potential race to the bottom?
So I think now is the time to really take stock of what we've already done, how that has turned out, and what our actual goals are with what the U.S.'s actual goals are with this sort of tit for tat that keeps escalating. And I think now's the time to be a lot more strategic. And instead of, you know, racing with America First policies and sort of pushing this decoupling faster and isolating the U.S. more, I think we need to take a step back and think about what we actually want to accomplish, how we can accomplish that, what's worked so far, and not just sort of tick off Beijing and also not sort of make Beijing retaliate more and sort of take this farther and farther until more consumer-facing companies and more consumers and more businesses are increasingly caught in the middle.
All right, Bloomberg opinion columnist Catherine Thorbeck there. Let's take a look at how Asian chip stocks are reacting at the moment. Of course, just to recap for you, this new set of restrictions does create 3 tiers of chip curbs. Those allies that are closest to the US would have unfettered access to chips, and then you keep moving down the list until you get to the most restrictive Tier 3, where China, Russia, Iran, North Korea, obviously other such countries would be heavily restricted in terms of their access. The Nvidia CEO Jen-Hsun Huang, of course, urging a go slow on this idea, and it's a bit of a mixed bag for chip makers at the moment. A lot of stock-specific stories going on here, of course, at the moment. SK Hynix, though, performing pretty well, better by more than 3.5% in Korea at the moment. We have more ahead on the Asia trade. This is Bloomberg.
Tariffs is going to be the one that is the most, that's for equity investors, that's going to be the biggest focus because that can affect earnings probably the most severely in growth. I don't think we're going to know about taxes for quite a while. I think tariffs we're going to know quite a bit in the next month or two. If they can execute on all these policies and we can kind of get to a point where the markets get comfortable with this, the second half of the year could be much, much better for equities.
Morgan Stanley Chief US Equity Strategist Mike Wilson there. Quite a bit of consternation as we get into the end of the week. We're awaiting those key US jobs data numbers and how that potentially kind of changes the picture further when it comes to Fed expectations. We are seeing that dip, of course, across Asian shares after Wall Street traders refrain from making big bets. We're seeing that continue when it comes to US futures as well. S&P futures down by about 0.25%. We're also seeing some reluctance to bet big when it comes to Greater China and Taiwan as well. TAIEX futures looking softer. We're expecting to see a lot of the chip maker and AI and tech-related names reacting to the latest push by the outgoing Biden administration to put in place more of these tiered restrictions on access to advanced technology. We're also getting quite a bit of risk aversion, of course, going into China's CPI. The broadly inflation numbers, the CPI numbers are expected to approach zero. We know that factory gate numbers have already been in deflationary territory for quite some time. So FTSE A50 China futures, they're off by 0.2% in that last trade. We have also seen quite a bit of support needing to come out for the yuan as well. So watching China very closely today.
Well, let's check in on some of the stocks to watch when markets do open in Hong Kong and mainland China. Keep an eye on Tencent. As we were just discussing, it's brought back about 8 million of its Hong Kong listed shares over the past 2 days, and this is after the Pentagon blacklisted the company for alleged links to the Chinese military. Chinese property developer Sunac also in focus as investors grow anxious about upcoming interest payments. And in the auto sector, Geely has announced plans to sell 5 million vehicles a year by 2027. Let's take a look at some of the major benchmarks around the region at the moment. It's a bit of a lackluster day with going backwards in Japan, the Nikkei off by about 0.5%, almost every sector on the index lower. A similar story here in Australia, almost every sector in the red as well, the index off by more than 0.4%. We did just have a very weak reading on retail sales as well. Kospi, meanwhile, just in positive territory by just a few points. We did hear from LG Energy earlier announcing a shock operating loss. That stock off by more than 2.5%. That is it for the Asia trade. Markets coverage continues as we look ahead to the start of trade in Hong Kong, Shanghai and Shenzhen.